Today is Sunday, April 19th, 2026. Tax day was 4 days ago. You filed, or you extended. Either way, most Americans think the tax story is over for another year. It is not by a long shot. Because starting Monday, April 20th, the Internal Revenue Service enters what insiders call compliance season. The filing window closes, the matching begins. The automated systems that spent the last 3 months receiving 164 million individual tax returns, 8 billion information returns from banks, brokerages, payment processors, and employers now begin cross-referencing every dollar reported against every dollar earned. And in 2026, for the first time in the modern era, that cross-referencing is being done by artificial intelligence operating inside an agency that has simultaneously lost nearly a third of its human auditors and been given explicit instructions to find more with less. The irony of that combination is the story almost nobody is telling clearly. And the people it targets most efficiently are not the billionaires with offshore trusts. It is you, the person who did everything right, the person who opened a high-yield savings account because every financial advice column in 2023 and 2024 told you to, the person who put money in a CD, the person who kept their emergency fund in an account generating 4 or 5% interest, the person who may not have fully realized that all of that interest is taxed as ordinary income at your full marginal rate every single year, automatically reported by your bank directly to the IRS, and now being matched against your return by an AI system the IRS CEO described in writing just 16 days ago as the future of enforcement. This is the savings tax. It is not a new tax code provision. It is not legislation. It is the collision of 4 separate realities that arrive simultaneously in the American economy and the American tax system, creating an enforcement paradox that is hitting ordinary savers harder than it is hitting the ultra-wealthy, in direct proportion to the effectiveness of automated surveillance over human investigation. And once you understand the 4 components of this collision, you will understand why Monday is not just the beginning of the week. It is the beginning of a compliance cycle that will send millions of Americans letters they did not expect, about income they may not have properly accounted for, identified by a machine they never saw coming. Let me build this precisely because the evidence is all on the record, and it is more disturbing in combination than any single piece of it is on its own. Component 1 is the savings tax itself, and it begins with a rule most Americans did not fully absorb during the years when it did not matter. For most of the period from 2010 to 2022, interest rates were near zero. Savings accounts paid a zero, 0.5% or less. A family with $10,000 in their emergency fund earned $5 per year in interest. Nobody cared. Nobody noticed. The 1099 INT form arrived in the mail, and most people threw it away because the number was so small it did not affect their taxes by any meaningful amount. Then the Federal Reserve raised rates. Starting in March 2022 and continuing through July 2023, the Fed delivered 11 rate hikes totaling 525 basis points. The federal funds rate went from effectively 0 to 5, 25 to 5, 5%. High-yield savings accounts, which had been dormant for a decade, suddenly became meaningful financial tools. Online banks began offering 4, 4.5%, 5% annual percentage yields. Certificates of deposit offered 6-month terms at 5, 1% and 1-year terms above 5%. The financial press, appropriately, encouraged Americans to move their savings into these instruments to capture returns that had not been available since the pre-2008 era. Tens of millions of Americans followed that advice, and they were right to follow it. High-yield savings rates peaked at 5% and above. That is real money. A family with $50,000 in savings earned $2,500 per year in interest at 5%. A family with $100,000 earned $5,000. That feels like a win. Extra income, free money for responsible saving behavior, except it is not free, it is taxed. Taxed as ordinary income. Not at capital gains rates of 0, 15, or 20%, which is what you pay on stock market profits held over a year. At your full marginal income tax rate. If you are in the 22% federal bracket, which covers married filers earning between roughly $94,000 and $201,000 in 2026, that $2,500 in interest generates $550 in federal taxes. That $5,000 in interest generates $1,100. If your state taxes ordinary income, which most do, the effective rate is even higher. In California, the combined federal and state marginal rate for a middle-income earner can approach 40%. Which means $5,000 in savings account interest becomes $3,000 after taxes. The Congressional Budget Office tracked this shift. When it updated its revenue projections, the CBO forecast that taxpayers would report $327 billion of taxable interest and dividend income in the 2024 tax year alone, up from $237 billion in 2019. That is a 38% increase in taxable interest income across the American economy in 5 years. $90 billion additional dollars of income that millions of Americans were suddenly earning, being automatically reported to the IRS by their banks via 1099 INT forms, and being matched against their tax returns. Here is the specific rule that creates the savings tax trap. Your bank is required to send you a 1099 INT if you earn $10 or more in interest. But the IRS requires you to report any savings interest earned, even if the amount is below $10 and no form was sent. Every dollar of a high-say interest you earned in 2025, every dollar in your CD, every dollar in your money market fund, every bonus your bank paid you for opening an account must be reported as ordinary income on your 2025 return, which you filed by April 15th, 2026. And if you did not report it or underreported it, your bank already told the IRS exactly how much you earned. The bank reports directly to the IRS. You report to the IRS. The IRS compares the two numbers, starting Monday. Component 2 is the IRS enforcement paradox, which makes the savings tax story simultaneously more threatening for middle-class savers and less threatening for the ultra-wealthy, in a way that should alarm everyone who believes in the principle that the tax system should apply equally. DOGE, under the directive of Elon Musk's Department of Government Efficiency, cut the IRS workforce aggressively throughout 2025. By March 2025, the agency's workforce had fallen by more than 11,000 employees, an 11% overall reduction according to the Treasury Inspector General for Tax Administration. But the cuts were not distributed evenly. For revenue agents, the professionals who conduct audits, the agency lost 3,623 people. That is 31% of its entire auditing workforce. Gone. From an agency that was already at a 25-year staffing low before DOGE began cutting. For the 2026 filing season, the IRS is operating with a budget approximately 9% smaller than 2025, according to CNBC's January 2026 reporting. The enforcement budget specifically was cut 8%, the lowest enforcement spending level since 1988 after adjusting for inflation, according to the Center on Budget and Policy Priorities. And President Trump's fiscal year 2027 budget request, released April 3rd, just 16 days ago, proposes an additional 18% cut to IRS enforcement. Every dollar cut from IRS enforcement costs more than $1 of revenue. That is not a liberal or conservative assessment. It is straightforward arithmetic, confirmed by multiple independent analyses. Yale Budget Lab published its estimate of the enforcement consequences in the last week, finding that DOGE layoffs alone are projected to result in $597, $8 billion in decreased revenue over the 2026 to 2035 budget window. Combined with the funding clawbacks, the total projected revenue loss is approximately $861 billion over the same decade. The IRS is being reduced in the name of efficiency, while the losses in tax collection from that reduction dwarf the stated savings. But here is the perverse specificity of who benefits and who does not. The audits that require the most human expertise are audits of complex returns, partnerships, pass-through entities, offshore accounts, and structured financial arrangements used by very high-income taxpayers and corporations. These are the audits that require experienced revenue agents with specialized training. They are the first to suffer when human auditor capacity is cut. The new audits targeting taxpayers with at least $10 million in income were reduced from 6,786 targeted in fiscal year 2025 to a target of only 2,264 in fiscal year 2026, according to IRS data cited by the Tax Law Center. That is a reduction of 2/3 in audits of the highest income Americans. The IRS hit only half its partnership audit targets in fiscal year 2025, completing 1,589 out of 3,174 targeted, and set even lower targets for 2026. Tax attorneys told the Wall Street Journal they are seeing more taxpayers and tax shelter promoters eager to cut corners or cheat. Because the human enforcement that would catch complex evasion is being reduced. Because the experienced agents who know how to follow money through layers of partnerships and offshore accounts are leaving faster than they are being replaced. Meanwhile, the automated matching system continues at full capacity. The computer that receives your bank's 1099 INT report and compares it to the interest you reported on line 2B of your Form 1040 does not require a revenue agent. It runs on software. It does not get fired in a DOGE reduction. It does not retire early. It does not take a voluntary resignation package. It matches every digit reported by your bank against every digit you reported on your return, and it generates a CP2000 notice when the two numbers do not align. Automatically, at scale, for 164 million returns. This is the IRS enforcement paradox in its starkest form. The agency is becoming simultaneously less capable of catching sophisticated tax avoidance by the wealthy, because that requires human expertise, and equally, or more capable of catching ordinary income mismatches by middle-class savers, because that is automated. The result is a tax enforcement system that is structurally regressive in its operational reality, even if its stated policy is otherwise. Component 3 is the AI expansion that the IRS CEO announced explicitly on April 3, 2026, just before Monday's compliance season began. Frank Bisignano, who serves as IRS CEO and simultaneously as the Senate-confirmed Commissioner of the Social Security Administration, submitted the fiscal year 2027 congressional justification on April 3rd. In it, he wrote that data-driven enforcement is one of the 3 strategic priorities of the IRS going forward. Specifically, the IRS is modernizing enforcement through expanded use of artificial intelligence, advanced analytics, and improved data integration. He wrote that these tools allow the agency to more precisely identify high-risk noncompliance and fraud and focus enforcement resources on higher-value cases. The IRS will do with AI what it can no longer do with human agents: identify patterns, match data, flag anomalies, generate notices. For ordinary income sources, including savings account interest, this is already how enforcement works. The 1099 INT matching is automated. The gig income matching through 1099K is automated. The dividend and capital gain matching through 1099B and 1099DIV is automated. These systems do not require the 3,000 auditors who just left. They were already running, and they are now being expanded with AI capabilities that allow more sophisticated pattern recognition. This means the compliance season that starts Monday is not the same compliance season that existed 5 years ago when there were more human auditors, but less sophisticated automated detection. It is a system that has fewer human investigators and more automated surveillance. For income that leaves a clear digital trail, which includes every dollar in a high-yield savings account, the combination of fewer humans and smarter machines does not reduce enforcement risk. It potentially increases it, because the machine never misses the 1099 INT that a human auditor might have overlooked in a paper-heavy case file. The Yale Budget Lab noted a specific concern in its recent analysis. The data sharing between the IRS and the Department of Homeland Security, mentioned as a variable that could further reduce revenue through compliance impacts, represents a new dimension of how the tax agency interacts with other government data streams. The specific dynamics of that data sharing and its consequences for taxpayer behavior are not fully transparent. But the direction is clear. The IRS is becoming more reliant on data integration and less reliant on human expertise. And data integration catches the income that generates data. Savings account interest generates a 1099 INT. That is data. Gig income above $20,000 generates a 1099K. That is data. Dividends generate 1099 divs. That is data. Capital gains generate 1099Bs. That is data. Every source of ordinary middle-class income has a corresponding data trail that feeds directly into the matching system. Complex partnership allocations, offshore account gains, trust distributions, and carried interest are far more data sparse in the tax system. They require human investigation to establish the true tax liability. Fewer human investigators means less of that investigation happens. Now apply the 3-stage historical pattern to prove this is not new. Because this specific dynamic, where automated systems catch ordinary earners while complex avoidance escapes human scrutiny, has precedent in 3 different eras. The first case study is the 1970s savings rate shock. Between 1977 and 1981, the Federal Reserve allowed rates to rise dramatically as it fought the worst inflation since World War II. The federal funds rate, which had been below 7% in 1977, hit 20% in June 1981. Savings account rates at commercial banks followed. Ordinary Americans with savings accounts were suddenly earning 8, 10, 12% interest. Many of them had never in their adult lives earned meaningful savings account income. The 1099 INT form arrived in their mailboxes, and a generation of taxpayers discovered for the first time that their bank accounts generated taxable income. The IRS Correspondence Division was overwhelmed. Tax preparers reported their clients were shocked by unexpected tax bills they did not anticipate when they made the responsible choice to put money in the bank. Sound familiar? In 2022, millions of Americans who had held savings accounts for years without generating any meaningful interest income suddenly began earning 4 and 5%. The shock was not as dramatic as the 1970s in percentage terms, but the population of people affected was larger because more Americans had more money in savings accounts than they did 50 years ago. And the reporting system, which was primitive in the 1970s, is now automated and comprehensive. Every dollar earned in interest is known to the IRS before you file. The second case study is FATCA and the birth of the automated wealth audit. The Foreign Account Tax Compliance Act was signed in 2010 and came into full force by 2014. For the first time, the United States government required foreign banks in over 100 countries to report directly to the IRS on financial accounts held by American citizens. The logic was simple. Americans were using offshore accounts to hide income from the IRS. The solution was to build an automated reporting system that generated information returns on foreign accounts and matched them against U.S. tax returns. FATCA was, in its mechanics, the prototype for the current domestic automated enforcement system. It demonstrated that systematic, automated data collection from financial institutions could dramatically change tax compliance for income categories that had previously been opaque. Before FATCA, offshore accounts were largely invisible to the IRS. After FATCA, they generated data that flowed directly to the matching system. The consequence for taxpayers who had been non-compliant was abrupt and severe. The consequence for the future of tax enforcement was a template. If you can create a data feed from a financial institution to the IRS, you can automate enforcement for that category of income without human auditors. That template is now being applied domestically. Every high-yield savings account, every CD, every money market fund, every interest-bearing checking account generates a 1099 INT that flows directly to the IRS. The matching is automatic. The enforcement is automatic. What changed in the last 3 years is not the existence of this system. It is the scale of income it catches, because rates rose from near 0 to 5%, and millions of Americans started earning meaningful amounts of taxable interest for the first time in their financial lives. The third case study is the crypto reporting experience of 2021 through 2024. When cryptocurrency became mainstream and millions of Americans began buying, selling, and trading digital assets, the IRS was initially unprepared to track those transactions. But the agency progressively expanded its information reporting requirements. Exchanges were required to report to the IRS. Form 8949 capital gain calculations were required on returns. And the IRS launched a specific enforcement initiative where AI was used to cross-reference information from exchanges against tax returns, identifying filers who had received crypto gains but failed to report them. The crypto enforcement wave generated a significant number of CP 2000 notices and audit triggers, not primarily for the most sophisticated crypto traders who used offshore exchanges or complex DeFi structures, but for ordinary retail investors who bought Bitcoin on Coinbase, sold at a gain, and did not realize they owed capital gains taxes. The pattern is identical to the heist A story. The ordinary earner, using a mainstream, reported platform, generating a data trail that feeds automatically into IRS matching, receiving an unexpected notice. The sophisticated evader, using less reported structures, receiving less scrutiny because human auditors are required to find them, and those auditors are now being cut. Apply the pattern to the current moment with specificity. A family earning a combined $110,000 per year, solidly middle class by any definition, took the advice of every financial journalist and personal finance influencer from 2022 through 2025. They moved their $40,000 emergency fund into a high-yield savings account earning 8%. They earned $1,920 in interest in 2025. Their bank sent a 1099 INT to both them and the IRS for that amount. If they did not add that income to their taxable income on their return, or if they received a new 1099 INT from a different account they forgot about, the IRS matching system, running Monday morning, will identify the discrepancy. A CP 2000 notice will be generated. It will arrive in several weeks. It will propose additional tax due, plus interest, plus potentially a 20% accuracy-related penalty if the underpayment meets the threshold. That is not a rare edge case. The CBO projected $327 billion in taxable interest income reported by Americans in 2024. With that volume of interest income flowing through the system, and with the significant number of first-time savers who never previously had to think about 1099 INT income because rates were near 0 for a decade, the mismatch rate between bank-reported interest and taxpayer-reported interest is almost certainly elevated compared to prior years. The system will find those mismatches automatically. Monday, the net investment income tax adds a further layer that most middle-class investors do not know exists. The NIIT is a 8% surcharge on investment income, including savings account interest, for filers whose modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married filers. So a dual income household with combined income of $260,000 that earned $5,000 in HICE interest pays not just their 24% marginal federal income tax on that interest, but an additional 8%. That is 8% federal tax before state taxes. Nearly $1,400 on $5,000 of interest. On money they already paid taxes on when they earned it. The NIIT is not new. It dates to the Affordable Care Act. But it is catching far more taxpayers now than it did when interest rates were near 0. Now name the 3 false narratives that most people carry that prevent them from engaging with this story clearly. The first false narrative is that the IRS cuts mean you are less likely to face scrutiny. This is true for human audits of complex returns. It is not true for automated matching of information returns. The CP 2000 Automated Underreported Program, which generates notices based on computer matching of 1099s against returns, does not require a revenue agent. It runs on computers. The 31% reduction in human auditors has essentially no effect on the CP 2000 system's ability to identify and flag discrepancies between the interest your bank reported and the interest you reported. The two most common sources of CP 2000 notices are unreported 1099 INT income and unreported 1099B capital gain income. Both are machine matched. Both continue at scale regardless of how many human auditors leave. The second false narrative is that the savings account interest tax is small enough to ignore. For the family with $40,000 in savings earning 5%, the interest income is $2,000. The tax at 22% federal plus 5% state is approximately $540. That is not catastrophic, but it is real. It is unexpected for millions of Americans who did not budget for it. It appears as either a reduced refund or an unexpected balance due on their return. And if they did not adjust their withholding or make estimated payments, which most ordinary employees do not, it arrives as a surprise in April or in the CP 2000 notice that follows. More importantly, the aggregate effect of this tax across tens of millions of savers represents a meaningful transfer of wealth from the Americans doing the right thing financially, putting money in savings and keeping it liquid, to the federal government, which taxes that responsible behavior at ordinary income rates, while long-term stock market gains receive preferential capital gains treatment. The third false narrative is that this enforcement reality is politically settled and stable. It is not. The IRS CEO, Frank Bisignano's dual role managing both the IRS and the Social Security Administration is itself an unprecedented institutional arrangement that introduces its own risks. The Trump administration's 2027 budget proposes an 18% further cut to enforcement. The Yale Budget Lab projects the total revenue loss from the combination of staffing cuts and funding reductions at $861 billion over the next decade. At the same time, the AI expansion is being accelerated for the income categories that are already tracked digitally. The system is moving simultaneously toward more automated digital surveillance of ordinary income and less human investigation of complex avoidance. That trajectory, if continued, produces a tax enforcement system that functions as a precision tool against ordinary savers and a blunt or absent instrument against sophisticated avoiders. Here is what you can do with this information, starting today, before Monday's compliance cycle begins. First, know your interest income number. Pull every 1099 INT form you received in early 2026 for tax year 2025. Every bank account, every CD, every money market fund, every online savings account, add them up. If the total differs from what you reported on line 2B of your Form 1040 or from what your tax preparer entered, and if you have already filed, you have two options. File an amended return proactively, Form 1040X, which reduces or eliminates accuracy-related penalties if the IRS would have found the discrepancy anyway. Or wait for the CP 2000 notice and respond accurately and promptly. Either approach is better than ignoring a discrepancy that the computer has already identified. Second, understand that savings account interest is taxed at ordinary income rates and plan accordingly going forward. If you earn meaningful amounts of interest, the appropriate response is to either make quarterly estimated tax payments, adjusting Form 1040 ES based on your expected interest income, or increase your employer withholding on Form W-4 to account for the additional income. This is not optional. The IRS charges interest and potentially underpayment penalties when taxes are not paid throughout the year. The penalty for underpayment is calculated at the federal short-term rate plus 3 percentage points. In the current rate environment, that is a real cost. Third, understand the difference between tax-deferred and taxable savings. A high-yield savings account and a taxable account generates interest that is taxed immediately every year at ordinary income rates. The same money in a Roth IRA high-yield savings account or Roth IRA money market fund generates interest that is never taxed, provided you follow the qualified withdrawal rules. The contribution limits for Roth IRAs are $7,000 in 2026 for filers under 50 and $8,000 for those 50 and older. The income limits apply. But for Americans within those limits, shifting some savings from taxable accounts to Roth accounts is the legally available alternative to paying ordinary income tax on interest year after year. Health savings accounts offer triple tax advantages, contribution deductibility, tax-free growth, and tax-free qualified medical expense withdrawals for those with eligible high-deductible health plans. Both are mechanisms the tax code explicitly provides to reduce the ordinary income taxation of savings. Fourth, understand the CP 2000 notice if one arrives. It is not an audit. It is a proposed adjustment based on automated matching. You have the right to respond. You can agree, in which case you pay the proposed adjustment. You can disagree, in which case you provide documentation showing your reported amount was correct. You can partially agree, acknowledging some discrepancy while disputing the rest. The IRS gives you a specific response window, typically 60 days from the date on the notice. Responding within that window is critical. Ignoring a CP 2000 notice converts it into a tax assessment that can result in collection action. Fifth, consider whether your 2025 interest income has been underreported and whether an amended return or voluntary disclosure makes sense before a CP 2000 arrives. Voluntary correction of errors generally produces better outcomes than waiting for the IRS to find them, because the accuracy-related penalty does not apply to corrected returns that are filed before a correspondence examination begins. The savings tax story is not the story most Americans heard when they were advised to open a high-yield savings account at 4 or 5%. The advice to open the account was correct. The interest earned was real. The tax on that interest is also real, automatic, already reported to the IRS by your bank before you filed, and being matched against your return by a computer that woke up this morning and will be working Monday. The IRS enforcement paradox is not the story most people heard when they read that DOGE had cut a third of IRS auditors. The cuts are real. The reduction in complex audits of the ultra-wealthy is real, but the automated matching that catches ordinary savers who underreported their 1099 INT income is not a human function. It was never a human function. It is a machine function. And the machine did not retire under any deferred resignation program. The AI expansion is not a story that received meaningful coverage outside of the April 3rd congressional budget justification, but the IRS CEO published it in writing with his name on it. The agency that is simultaneously firing auditors is investing in artificial intelligence to improve its data matching capabilities. For income categories that generate digital data, which includes every dollar earned in every bank account in America, that combination is not a weakening of enforcement. It is a restructuring of enforcement. From human expertise to machine matching, from complex avoidance investigation to automated ordinary income surveillance. And Monday marks the beginning of the season when that restructured system begins processing 164 million returns alongside 8 billion information returns, looking for discrepancies, generating notices, and requiring responses. Subscribe right now because the next video in this series covers the specific mechanics of the CP2000 automated underreporter program, which categories of income generate the highest volume of notices, which taxpayers are most likely to receive one this year, and what the exact response process looks like when you get a letter from the IRS saying you owe money you did not think you owed. The notices are coming. Understanding what they mean, what your rights are, and what the correct response is before one arrives is the difference between a manageable adjustment and a compounding problem that costs you significantly more than the original tax discrepancy. The savings tax is real. The machine is running. Monday is here.